Why mortgage-backed securities? Why is now a great time to think about allocating this asset class? Well, from a valuation standpoint, they definitely are on the cheaper side of the market. This is one of my favorite slides. It shows the spread history of different asset classes. This is going back 10 years. And the lower the dot, the more expensive the asset class is relative to its own history. So, for example, we can see many dots down here at the bottom, having enjoyed a rally in spreads. But investment grade corporate bonds, for example, first percentile, only been more expensive 1% of the trading days over the last decade. On the very far right of the table on the bottom, triple B CLOs have had a great run. This is the tightest they've ever been in the last 10 years. So the dots that are higher up on the chart provide more relative value. And on the left-hand side of the chart are the more investment grade pockets of the market, which we're targeting. Just happens to be all the sectors within both DMBS and DCRE showing relative value. Agency mortgages up there, close to 80th percentile, and then RMBS and CMBS kind of in the middle, looking fairly valued, whereas most of the corporate credit markets are looking very expensive on a spread basis. Some would argue that the agency mortgage-backed spread is skewed a little bit because we were in a very low spread environment thanks to quantitative easing. So I went back 20 years, and when I go back 20 years, some of those indices disappear. I don't have an RMBS index that goes back 20 years. The CLO indices started in 2014, but we can kind of see the same picture. Corporate bonds at the very bottom, both investment grade and high yield, having done very well, are now looking on the expensive side with very tight spreads. CMBS, a little bit below average, but still much cheaper than investment grade. And then agency mortgages up top, still almost 70th percentile. Now this 20-year rank kind of gets skewed by the GFC where spreads got really wide. So you have to take both these 10 and 20-year histories, taking into consideration some things like QE and obviously the GFC. But great time to take a look at these two ETFs because of the relative value, the wide historical spreads that the sectors offer. Now, before we dive into the portfolio, I thought it would be helpful for those that aren't as familiar with mortgage-backed securities to just give an overview of the asset class. Agency mortgage-backed securities, or MBS generally, are bonds backed by pools of mortgage loans, and the cash flows to investors are dependent upon the cash flows that come from the underlying mortgages. So every month, people pay principal based on their amortization schedule. They pay interest rate, and then they have the option to prepay some or all of their loan. And that's the uncertainty that you have with an MBS. You don't have a defined maturity date. You kind of get cash flows all the time. Sometimes they come back faster, sometimes they come back slower. And for that uncertainty, you're getting paid spread over treasuries. There are also what are called non-agency mortgage-backed securities. These aren't backed by the agencies being the government-sponsored entities, Fannie, Freddie, and Ginnie Mae. These now, while you also take the prepayment risk, just like the agency mortgage bond, you have to take the credit risk too. So agency MBS is both explicitly and implicitly government guaranteed. The issuers, Fannie, Freddie, and Ginnie Mae, if somebody does default, they buy those loans out of the MBS, and that comes through at 100 cents on a dollar to the bondholder. So no credit risk for agency mortgages, just taking on that prepayment risk. For non-agencies, you still have the prepayment risk, and you take on that credit risk. And for taking on incremental credit risk, you get paid more spread than you would in the agency mortgage-backed securities. The MBS universe is one of the largest parts of the global fixed income market. Here you can see it's a $10.8 trillion market, largely dominated by the agency mortgage-backed securities, those Fannie Mae, Freddie Mac, and Ginnie Mae bonds. That's $9.1 trillion. There's also what are called agency collateralized mortgage obligations, and we'll dig into that a little bit later. These are packaged and structured bonds backed by agency mortgage pools. And then, of course, non-agency mortgage-backed securities. which are have both the legacy bonds from pre-crisis and what we call new issue or non-agency 2.0, which are new mortgage-backed securities in the non-agency space, and that market's about 600 billion. It's meaningful. It's part of the agency mortgages are part of the Bloomberg index. They're about a third of the Bloomberg aggregate bond index. And so many institutional investors have exposure. Most core plus or core bond funds will have that exposure. So it's definitely a part of the fixed income universe that you should be considering for your investment portfolios. How do we at DoubleLine and other market participants analyze the risks of this MBS? Well, the first risk we talked about is prepayment risk. And there's different things that can affect prepayment risk. The most important thing is obviously the mortgage rate. If you have a very high mortgage rate, today's prevailing mortgage rate is in the low sevens. So if interest rates were to fall, let's say 100 basis points, and mortgage rates were to fall 100 basis points, a lot of those borrowers would obviously refinance. So looking at mortgage rates drives prepayments. Loan balance is also something we think about and analyze. Larger loans prepay on average faster than lower loans because for incremental changes in the mortgage rate, there's more incentive to refi if your loan is larger. Lastly, originators and servicers can drive prepayment activity. Some servicers are much more streamlined at the refinance process. So we see certain types of servicers refi faster than others into that falling rate scenario. Moving on to credit risk, while we still need to think about prepayment risk and try to model out prepayment risk, now we're exposed to the credit risk of the underlying borrowers. We're going to look at their credit score. We call it the FICO score, Fair Isaacs Credit Organization. Usually the credit scores of borrowers in today's non-agency market is pretty high, typically over 725. Back in the day, prime was around a kind of a 740, 750 FICO. There's really not much subprime in the non-agency market. Subprime really has moved to the agency market in the form of Ginnie Mae loans through the FHA and VA programs. So we look at credit scores. A higher credit score, obviously less default probability. But what we found through the global financial crisis was that loan to value was actually a bigger driver of defaults because some people with good FICO scores ended up defaulting too because they had no equity in their homes. So if loan to values are low, people are putting money down and have equity in their home, they're much less likely to default. And debt to income, obviously another good metric, seeing how much debt outstanding the borrower has relative to their income. And so those are the types of things we look at. We look at the loan level information. We get all these statistics about the loans, and we use those to help us model out the prepayment potential and the potential credit risk in these different securities. Why should you add agency mortgages to a portfolio? So these are some of the benefits of MBS. Historically, outside of a very recent period when we saw rates rise in this really aggressive Fed hiking cycle, you can see that the blue line on the bottom is agency mortgage-backed securities. The yellow is the Bloomberg index. The treasuries, U.S. treasuries are in the dark gray, and the light gray is investment grade corporate bonds. And historically, mortgages behave with much lower volatility than the other parts of the fixed income market. You can see that investment grade credit took a big spike during the global financial crisis, and even during the rate rise period, starting in the kind of the middle of 2020, you saw that while mortgage volatility picked up, corporate bond volatility was still much higher. But I think that a lot of the spike in volatility in MBS had to do with coming out of QT. We manipulated prices with QE. We're coming out of QT. We saw a lot of mortgage extension happen. We saw this crazy hiking cycle by the Fed. And so I think on a go-forward basis, I expect the volatility of MBS slowly to normalize and kind of behave in the same way it did in the past, having that lower volatility. Thinking about portfolio diversification, MBS, both agency and non-agency, tend to have lower correlation to equities and corporate bonds. So here you can see agency MBS and agency CMBS have some of the lowest correlations outside of treasuries to the equity market. And then the credit sectors, non-agency MBS and non-agency MBS, also have less correlation to equities when compared to the corporate credit markets, things like investment-grade corporate bonds, bank loans, emerging markets, and of course high yield, which is the most correlated to the equity markets. So adding MBS to your portfolios can help diversification based on these historical correlations. Rising interest rates. Again, outside of very recent movement, call it 2021 through now, or 2022 through now, MBS historically has done pretty well in rising rate environments. So we went back and we said, let's go back and look at periods of time when the 10-year Treasury yield rose by 100 basis points or more, and we find 19 separate occasions. During those occasions, MBS outperformed 16 out of 19 times, and those 3 times it didn't outperform were the very recent periods that we saw because of what I discussed earlier, coming out of quantitative easing into quantitative tightening, and just one of the worst environments for MBS. And why does MBS tend to outperform? Well, unlike a corporate bond where you and or a treasury in this case, where you get semi-annual coupon and your principal back at maturity date, you're always getting cash flows. You're constantly getting cash flows back on a monthly basis, both interest and principal, that you can reinvest into the rising rate environment. And that tends to create a better performance into that rising rate environment. And so thinking about MBS after experiencing the underperformance it has very recently, this sets up, I think, going back to a more normalized market where it can do better in rising rate environments versus some other parts of fixed income. In this instance, we compare it versus U.S. Treasuries. Risk off. Agency MBS is good for your portfolios for risk off. Treasuries, of course, also help historically. Again, the very recent history that we've had these last couple of years when we had equity sell-off and bond yields rising, this was, I think, a unique situation in a Fed hiking cycle with elevated inflation. If you go back, over 30 years and we look at periods of equity drawdown, usually when you're in that kind of big risk-off scenario, let's look at the far right here, equity is down over 20%. It is treasuries and mortgages that really create the downside protection for you. And so you can see in that down 20 scenario for the S&P 500, treasuries do about 10%, mortgages do a little bit less, 870 on average. That has to do with prepayments kicking in and the bonds getting a little bit shorter, that negative convex year call risk. But longer mortgages, if you go into the CMO market, those do really well because they're locked out from those prepayments. So you'll see corporate bonds, they don't do terribly. On average, they've done about 270 in those periods of equity drawdown. But that's because there's spread widening that happens in the corporate credit markets that offsets some of the benefit and the duration inherent in your portfolio. So MBS is a good diversifier relative to a portfolio of credit for a risk off move. Of course, treasuries can do that for you too, but given relative valuations, we think MBS looks interesting here relative to treasuries. And why does it look interesting relative to treasuries? So we did an analysis going back to 2000, and we looked at the rolling excess return. How much return over treasuries did an MBS portfolio do through time over these 1, 2, and 5 year rolling periods? And you can see on the bottom left, we have a table, and I'm going to guide you to the blue. So this is the 50th percentile. So on average, or median, rolling returns, positive excess return over treasuries. So on average, an MBS portfolio does generate excess return over treasuries through time. You can see that it's about 38 basis points on a 5-year annualized basis. Now, sometimes it obviously underperforms. Sometimes it does even better. In fact, you can see the best it's ever done over a 5-year rolling period is 175 basis points over treasuries. But on average, it's that 38 basis points on a 5-year time horizon. Now come with me and take a look at the top line. That is through December 31st, 2024. The 5-year rolling average is negative 46 basis points annualized. So it's been behind treasuries by almost 50 basis points every year for the last 3 years because of what's happened coming out of QE, going to QT, the banks being out of the market, the Fed being out of the market. So all we need to do is go back to average historical returns, and you have, based on these metrics, 80 basis points of potential excess return on an annualized basis. If we just go back to how things used to be, obviously that could not happen, but if history repeats, and often it does within financial markets, mean reversion is a powerful thing. Given the recent underperformance, I think we're set up for some interesting outperformance on a go-forward basis. Here's a look at mortgage spreads today. We can go back to 2022, and we see that they got extremely tightened spread. This was when we were doing peak QE infinity, actually, and there was unlimited bond buying potential by the Fed coming out of the pandemic. And then we see this dramatic spread widening, where we went almost to about a 200 spread. This is the spread on what's called current coupon bonds. These are the bonds being manufactured today, backed by today's prevailing mortgage rate, which is in the low 7s. It gets packaged up to about a 6 coupon bond. Not every bond in the mortgage universe has this spread. Some are tighter. Those low coupon bonds from the pandemic era that are a 2 coupon backed by 3 coupon mortgages, those trade at a much tighter spread. Today it's a spread of probably around 50 to 60 nominally over treasuries, which is why active management is really important in MBS. And we're going to dig into that in a little bit, but the index has a lot of low coupon bonds. It doesn't have as many of these high coupon bonds that have these wide spreads. But you can see the spread's still wide relative to history, has some room for compression. And in the meantime, you're picking attractive carry. Now, why did the spread widen so much? Mortgages are highly correlated to rate vol, and we saw rate vol increase dramatically as the Fed was hiking rates. And then the 3 largest buyers of MBS were the Fed, banks, and money managers over the last decade. We took basically all 3 of them out of the market. The Fed stopped buying. They went to do QT. We saw huge deposit outflows out of banks. So they were selling assets to raise capital. Some went out of business because of deposit outflows, like Silicon Valley Bank. And money managers saw huge outflows out of mutual funds, ETFs, separately managed accounts. So you take the 3 largest buyers out of the market with heightened rate volatility, it's no surprise that spreads widen. You see this leg down that happened at the end of 2023. That was the kind of end of the Fed hiking cycle, the Powell pivot, November of 23, and that helped stabilize markets. So we've seen the banks start to dip back in. So the banks have started to dip back in. Any deregulation could also create more bank demand. So the market is definitely stabilized. A catalyst for a move lower would be increased bank participation and or rate vol coming down, which would be a bond rally. So in a bond rally, in a risk-off scenario for equities, the mortgage spreads would probably come in and you'd get some good returns out of that. If rates go sideways, then you get to clip this attractive spread, which, by the way, the corporate bond index has a spread of 80 today. And here you have a government guaranteed bond that is at a spread of almost 140. Another reason to consider mortgages is the risk has come down a lot. Convexity is a measure of prepayment risk. It's the blue line. It's usually negative because mortgage loans are callable. And so much of the mortgage index is out of the money because people have low coupon mortgage loans from the lows in rates, that you can see that measure of risk, the convexity, is very, very is flipped positive, actually, for the first time in a long, long time. And a lot of that has to do with dollar price. The dollar price is in the dark gray, and you have many bonds at deep discounts where prepayments are upside. So the spread is wide. The risk for some bonds is lower. For the index, generally, it's close to the lowest it's been in a long time. And then versus corporates, corporates have done tremendously well. We own corporate bonds in many of our other portfolios. This is a mortgage-only strategy. It's agency, non-agency only, up to 50% non-agency, has to be investment grade. But corporates have done really well, but their valuations are very expensive. And mortgage spreads, looking at history, look attractive relative to corporates. And here you can kind of really see the diversification in action. So the brown, dark brown, looks like dark brown line is the investment grade corporate bond spread. And you can see during the GFC, you had obviously that big spike. In 2012, you had the European sovereign crisis. You had another spike in corporates, but mortgage spreads remain contained. 2016, you had the energy crisis happening and a lot of defaults picking up in the high yield bond market. You see corporate spreads blow out there, mortgage spreads stay contained. This is diversification in action. I know it just seems like stocks only go up and spreads only tighten over the last couple of years, but through the fullness of time, market cycles happen, and eventually we'll see some other event that will cause spreads on credit to widen, and MBS could be that diversification for you, as we see in this chart. What do we do differently? Why go active versus just going and buying a passive index? Well, we have different tools in our toolkit. The index is a cross slice of the mortgage universe. It's got 30-year fixed rate mortgages in it, 20-year fixed rate mortgages in it, 15-year fixed rate mortgages in it. It's about 85% 30-year and about 15% between 15 and 20-year mortgages. And when you buy the mortgage index, you get that kind of pro rata slice of what's out there. What we can do, there's a couple different things that we can do. We can go in and we can pick which coupon bonds to buy, basically not replicating the bond index, but seeking relative value across the coupon stack versus low coupon. There's low coupon bonds as low as a 1.5 coupon from the very lows in interest rates. And we have bonds with 6.5%, 7% coupons too. So there's a variety of bond coupons we can select. They all trade at different dollar prices. The lower the dollar price, the lower the coupon. And then we can look at the collateral. Earlier we touched on the different drivers of prepayments like loan balance and servicer, and you can look at geography. And so these are all different ways that we can create excess return, is actively selecting where to play in that coupon stack and different types of collateral. The second thing we can do is we can go into the collateralized mortgage obligation market and also TBAs, which are MBS futures. And sometimes TBAs, because of supply-demand technicals, they can trade with excess yield relative to just buying the pass-throughs. And the CMO market is where Wall Street takes pass-throughs and slices them into different pieces, and we can express our view on the curve, and we can express our view on prepayments. And sometimes those bonds trade at wider valuations than pass-throughs because, again, of supply and demand technicals. Like when Silicon Valley Bank assets were being liquidated by the FDIC through 2023, CMO spreads got very wide. We bought CMOs across all our portfolios, and then since then they've been tightening in, and they trade expensive now relative to pass-throughs. So we've been decreasing CMOs and adding to mortgage pass-throughs. But that's the second tool. The third tool is credit. We can go into mortgage credit, investment grade mortgage credit. We can go up to 50%. Today's spreads are tight. We're about 15% credit, and we're actually going to be decreasing that by 2%, given just how tight spreads have gotten across many credit markets. And mortgages, agency mortgages, we think, have a little bit better relative value now. So decreasing our credit risk a little bit right now and adding to MBS. And one day, if spreads widen a lot, we will ramp that investment grade credit portfolio up. It has to be BBB rated or higher. Lastly, tools of active management, duration and curve. We can take an active role in our duration relative to the benchmark. Today, we're a little short of the benchmark duration. We have a duration of in the low to mid fives, and we can take positions on where to be on the curve as well. How do we look at securities? Well, it's all about modeling cash flows. So we're looking at that collateral. We're looking at the loan balance, the FICO scores, the debt to income ratios, the geographic distribution of the loans. And we're modeling out what we think prepayments could be in various economic and interest rate environments, what defaults could be for credit securities, what ultimate recoveries could be if borrowers default. In many cases, there has been almost no losses because of the amount of equity people put down to buy homes in what's called the non-qualified mortgage market. We just took a look at this last week. There's been less than 2 basis points of cumulative loss since that market really picked up steam in 2014. So that's over 10 years of origination. I think it was something like $400 to $500 billion of loans or unpaid principal balance with less than 2 basis points of loss. So we run the cash flows, we run them through the bond structure, we analyze the duration and convexity, the potential for total return, and then we determine if the price is right. Are you getting paid the right spread to take on that risk? So those are the tools of active management. Wanting to just explain a couple things before we jump into the portfolio, but CMOs are collateralized mortgage obligations. They slice bonds into different cash flow profiles. A simplest one is a sequential structure. This is on the left-hand side, where all the prepayments and principal go to that first bond first. It needs to get fully paid down before the next bond gets paid, that intermediate cash flow bond, and then lastly, the last cash flow. What this does is simple structure, just creates different duration profiles because certain pools of capital just want different durations. Maybe banks want shorter assets to with their short liabilities, they'll buy the front cash flow. Maybe property casualty life insurance company buys that 3 to 7 year cash flow or an intermediate term bond fund. And then a defined pension or a life insurance company, maybe they like that long duration bond for their longer liabilities. And so there's times when supply and demand technicals can cause some parts of these markets to be wider than others, and we can seek relative value there. On the credit side, questions always come up about mortgage credit because of the GFC. One thing that we need to be cognizant of is that we're in the investment grade parts of the market, and these bonds are structured with what's called subordination or credit enhancement. If we're buying the AAAs, which is largely what we own in DMBS, they often have a lot of subordination, 20 to 30% subordination. Here, this hypothetical capital structure has 30 to 35%, which means that you need 30% loss to get hit on this bond. And we just talked about how of all the loans having been made since 2014 in that non-qualified mortgage market, 2 basis points of loss. So we're nowhere close to having the losses to hit the AAAs. Thinking about the GFC, the aggregate mortgage universe, I think took about 7 to 8% cumulative loss. So some bond structures got hit all the way to AAAs. Some bond structures survived depending on how much subordination they had. But that would imply, those double Bs and single Bs would have gotten hit here. But triple B and up, there's enough subordination to basically cover the amount of losses that the aggregate mortgage universe saw during the GFC. If you have any questions around CMOs and credit tranching, we're happy to take calls on that. It is definitely one of the more interesting parts of the market to learn about, but sometimes there's some confusion. So we try to simplistically describe them here, but of course, don't hesitate to reach out if you have any questions. Why should you add credit to an agency MBS portfolio? We did a thought exercise, and we did a 70-30 blend of agency and non-agency going back through time, and it generated, diversification and more yield on the credit, generates better risk-adjusted returns, or has the potential to generate better risk-adjusted returns. Here you can see this, we've circled that blend 70-30. Right below it is the return and standard deviation of the MBS index, and the Bloomberg aggregate index is right next to the MBS index as well. All right, finally, we've learned a lot about mortgage-backed securities, what they are, how we analyze them, why active is interesting, and the different tools of active management. Now let's take a look at the portfolio and really how it compares to the MBS index. So our duration is a little bit shorter, 5.4 years versus 5.6, and a little bit slightly negative convexity versus the index. But we have more yield. We have the credit that has more yield, and then our coupon selection is very different. So look at that bottom left-hand chart. The index is the light blue, and it's really dominated by these low coupon mortgage-backed securities because so many people bought a house to refinance in the low rate environment. And when you buy the MBS index, you're basically forced to get a lot of exposure there, and a lot of indexation is happening out there, and there's people always looking for these index names. So those low coupon bonds, they generally do trade with a tighter spread because they have less prepayment risk, but they're very expensive. They're trading at a tight spread of, the two coupon bonds are probably about a 50 to 60 nominal spread over treasuries. So we're very underweight those two coupon bonds. We have some 2.5 and 3s. You can see maybe about the same as the index on 2.5s. Those bonds have a lot of optionality. If rates fall, there's so much equity in those homes that you could see refinance activity pick up. Also, they have a long spread duration, meaning the change in price relative to change in spread is higher there than high coupon bonds. And so if rates do fall, we want to have some exposure there. We have kind of a barbelled approach. You can see that the dark blue lines, which is our coupon selection, is barbelled, having some of that exposure in the low coupons, but then also taking advantage of those wide spreads that we looked at earlier in on the run kind of new issue MBS, 5.5, 6 coupon bonds that have more carry. So it's one of the ways we get more yield in the portfolio. So we're kind of set up, if rates go sideways or higher, you've got the shorter duration of the high coupon bonds, you have the higher carry of those bonds. But if rates fall, we don't want to have no exposure to low coupons. We want to have some upside in those low coupons as well. So we have this barbelled approach. In the right column, in the middle, sector breakdown, we can now look at how we are different from the index in other ways. We have 70% in pass-throughs. The index is 100%. And then we can go into the other parts of the market. So we've got 15% in the TBA market, which is the agency mortgage-backed securities futures market. It was actually the first futures market even before Treasury futures started trading. That's a little tidbit of bond history. We've got today 12% in CMOs. That number was higher at one point, but we've been shedding some CMOs. And our biggest exposure in CMOs are called interest-only securities. Just like you can strip out the coupon from a treasury and create a treasury strip, you can take the cash flows from a mortgage-backed security and you can strip the principal and interest into two different parts. So one bond only gets the principal, and one bond only gets the interest. This is, again, one of those things Wall Street does when they slice and dice the cash flows. We're buying the interest-only parts of those CMOs backed by out-of-the-money mortgage loans. So mortgage loans that have coupons of, let's say, 3.5. So there's very little refinance risk. Rates would have to rally hundreds of basis points for there to be any refinance risk. So we're basically just clipping the interest coupon from those loans while holding this bond, and it's very steady cash flow, and the bond has very limited duration, just given it's all interest. And the spreads on these assets, or the yields on these IOs, are in some cases 6.5 to 7%. I mean, the high yield bond index yields low sevens, and here we can buy a government guaranteed security that's nuanced, but has a yield almost the same as the high yield index. So we have good exposure there, 10%. You're not going to get any of that in a bond index fund, or an MBS index fund. And then lastly, non-agencies at 15%. Going down to 13, we intend to sell a little bit of some of the stuff that's done really well. Some of the non-agencies have done really well along with the credit markets. And agencies have come in a little bit, but they on a relative value basis, we think that the agency market offers better value at this point versus the very high investment grade credits that we own in the non-agency market. So thank you for your time and listening to the section on DMBS.